Good morning, everybody. I'm just going to share the screen in a moment. Give me 1 second. Yes, so just a quick reminder that disclaimers on your screen. There's also a copy of that on the website. There's nothing here that we'll be discussing that's a recommendation in relation to other stocks we're talking about or the funds we're talking about, as you know. But the purpose of the seminars, again, as you know, every other Tuesday at 8:45 in the morning, is to give you our view on something we consider to be an important subject for the day, the week, the month, and an ongoing investment debate, which is important for us, important for our clients, and where we have a considered research-based view. So I'm just going to stop sharing for a moment. And today's one is the situations in the banking system, starting with SVB. We really couldn't not talk about it, given the importance of this for the market, and we have a fair amount of opinion and view on that. Just as a quick recap, it's been covered extensively in the press, so apologies if I'm going over the ground you're already familiar with, but it started just over a week ago with the distress in Silicon Valley Bank, SVB, a bit of a special case bank with a very strong franchise in California tech startup venture capital funded sector. The bank, it then spread to Signature Bank, a little known but well liked, a specialist New York bank. And then we had Credit Suisse, a rescue over the past weekend, and First Republic Bank of California is fighting for its life as we speak, and it looks like some kind of rescue is coming. What went wrong with SVB? Again, maybe as you know, it had a phenomenal inflow of deposits, and it was a real beneficiary of unprecedented funding conditions in the venture capital space. I mean, just to give you some numbers around that, in 21. The total number of venture capital funding in the US was 330 billion in 1 year. That's a lot of money. It's more than twice the level of 150 billion that was in the level of venture capital funding in 2018, 2019, 2020. Themselves already very, very active years for VC community. And a typical level, kind of in 06 through to 2013, was about 50 billion. So you can sense the real exponential upswing of cash inflow into that space. SVB then invested this money irresponsibly, in my opinion, in very long duration securities, probably miscategorizing them as hold to maturity. They didn't really have the depositor stability to justify that duration mismatch. And when the depositor outflow started, they attempted to plug the hole through a rescue rights issue that didn't work, and the rest is history. Signature Bank didn't have an asset problem as much, but it had its own depositor quirk. They attracted a lot of depositors from the crypto universe. They didn't do crypto business themselves, but they accepted that money. Again, that depositor base was flighty, and when it started to flow out, there was a quick reaction. And Credit Suisse, again, a very different set of problems on the asset side of the balance sheet, but again, the perception that the counterparties and depositors were losing faith, and very swift regulatory action. So that's the quick summary so far, and I'm just curious, Paul, what do you think about how the system is coping with all this?
Yeah, well, I guess this has been really the first big test of the regulatory regime put in place after the great financial crisis in 2008, and a whole load of new instruments and measures and abilities were put in place then. And I think you have to kind of conclude actually it's broadly been very effective. And you could say that SVB, that crisis shouldn't have happened at all, and that was largely, I think when this gets analysed, there's going to be quite a lot of attribution to the regulatory relaxation that was put in place under Donald Trump after great lobbying from the industry, bizarrely, to remove stress tests for banks between $50 and $250 billion. That number should remain much lower, because clearly SVB was far too big not to be conducting stress tests, and any kind of stress test would have shown the weakness of its balance sheet structurally and the duration mismatch, which you talked about. But that aside, the powers that the Fed had to sort it out quickly clearly were significant, were substantial, and did resolve the situation very fast. I mean, I suppose in the States, the Fed did have to resort to a new measure, which is to effectively guarantee all bank deposits. And I think we're into a new world where we've got used to the idea of quantitative easing. Really, what the Fed has now done is more like quantitative lending, And that's a whole new concept for us to get our head around, where they're lending against bonds, any bond portfolios at par, regardless of what they're actually worth. And so, you could say, well, this is a new thing, but clearly the bill for this is not going to go to the taxpayer in the US, it's going to go to the industry. So, yeah, I think while it's been painful and more painful than it should have been, that it's been quickly resolved. And in the UK, we had really the first big test of the regime with SVB UK, which was a subsidiary about which, there's very, very little published data. And, if you go onto a company's house, you won't find accounts for SVB UK because they haven't been published yet. Sources that we have quite close to the bank tell us it was a very profitable bank. I think it's been written about that. I think HSBC has said there's 1.6 billion of equity value in that business, which HSBC picked up for £1. The loans, while there's been people saying, oh, these are very risky loans. There's no real evidence to suggest that the lending book is bad. Yeah, so I think that will wash its way through pretty effectively. So in a way, the fact that the government was able to step in, there wasn't even, I understand, a major run on SVB UK on Friday. Just the regulator decided there was likely to be one, so they stepped in and effectively gave it to HSBC. I understand there were multiple bidders. It wasn't just HSBC. There's some people saying they were the only game in town. I don't think that's the case. There was at least one major bank alongside them, and quite a number of VC bids, because lots of people recognised this was potentially a real bargain. But I think the government clearly wanted a big name to stand behind it to really resolve it beyond doubt. And then in the Credit Suisse case, very quickly, what is remarkable is the AT1 story, the additional tier 1 equity bonds, which have been put in place after the new regulations in 2008, have largely paid the bill for the CSFB effective bankruptcy, really, because that was a solvency issue. It was a balance sheet problem. We don't really know what kind of issues UBS have taken on in that balance sheet. It's obviously huge, but UBS have got some guarantees to stand behind them. So the Swiss acted very quickly. In a way, that was the most significant of all of the bailouts, because it's by far the biggest bank and could have had the most far-reaching implications had it gone under. But there again, the new regulatory world has actually worked pretty well. What do you think about the consequences for the sector more generally in the US?
I'll agree with you completely that regulators, bank policymakers were really on the front foot on that and not taking any chances. We had a conversation with a former regulator, banking regulator, who highlighted some of the technicalities, the speed with which resolution was put in place, some of those exceptional measures. I mean, the US lending package can scale up to 2 trillion by some calculations. So the lessons have been learned, and reaction was very quick and sometimes very aggressive, as you pointed out. We also now see very clearly the increased vulnerability in the banking system. I mean, as somebody put very bluntly, in global financial crisis, we didn't have Twitter, and the internet banks didn't work as well. So this kind of virtual 24/7 bank run risk that we have now and we didn't have then is a new thing. That's the regulatory response to 2007, 2008, 2009 asset problems do not cover that. And one of the stark illustration of that, and I go by a third-party expert assessment. I'm not an expert on European banking stress tests, but apparently Europe has a liquidity stress test to test for a bank run. But their assumption is, can the bank withstand 30 days of consistent outflows amounting to something like 5% of the deposit base? That looks very pedestrian. Just to give you a sense, again, by some calculations, at this point, First Republic Bank in California lost 50% of their deposits and something like 70% of their uninsured deposits. So the speed with which bank runs occur is greater. And I think there will be regulatory, once the dust settles, there'll be regulatory tightening. There's probably going to be a little bit kind of further move towards utility banking model, consolidation towards bigger players, which we're already seeing in terms of where deposits are flowing. And the price for that is going to be kind of greater regulatory oversight and greater ongoing regulatory intervention. And that probably makes bank equity a more problematic investment. We don't own any banks in the Global Innovation Fund, as you know, but nonetheless, we're sort of aware of this increased pressure. Well, what's the impact on the UK portfolio and UK banking space from your perspective?
Yeah, well, one one real feature of this, which is sort of emerging and now being talked about quite a lot, is as a consequence of this whole problem over deposits, and particularly uninsured deposits, is that banks are going to be very wary of taking on deposits from businesses, because they, if you want to deposit 2, 3, 4 million pounds and you're a business, the bank's going to regard that, well, that might go any day. There's not much I can do with that money. And so, yeah, it's already incredibly difficult to open, if you're a business, to open a bank account in the UK, particularly if you're not a UK business. And we spoke to one of our portfolio companies about, well, why did you have your money in Silicon Valley Bank? And they said, well, that dated back to our IPO when we needed to open a bank account. And Silicon Valley Bank was the only bank in the UK that would open an account in less than 18 months. And that was many years ago, 5 years ago. Yeah, this situation is going to become chronic, and this is going to really require some thinking about it by policymakers, because clearly, if you can't open business bank accounts, you can't really do business in the UK. I don't know whether this problem is going to be mirrored in the US, but it's certainly already an acute problem in the UK, and I think it's likely to get really a whole lot worse, as for this very reason, that some deposits will just be regarded with just in the too difficult camp for banks, and just will have little interest in taking them on, and these are particularly businesses. I think in terms of our portfolio, we do have a bank in the small companies fund, and Terry Smith today interestingly has written about in the FT about why you should ever hold banks, and I think it's obviously worth considering the arguments that he has put forward. But one of which is, in no other industry, if your competitors get into trouble, does it cause you such a problem as in banking? He talks about the depositor problem, and so on. I would say that every industry has its significant risks, and they're always very particular to different industries. And in many industries, if your suppliers have a problem, you've got a big problem. It's just the way that one business impacts another is consequent on every company. But banking has a particular set of issues, and I'd just say the bar is very high for banks. They have to have incredibly good lending policies, very good risk management policies, and really, the financing of banks really matters, and how prudently that's done. So, applying a lot of scrutiny, and the bank we have, One Savings Bank, has consistently made a return on equity of 24–25%, which is, really standout in the sector. And if you start to look at their financing, it's not just instant access deposits. There's a lot of 1- and 2-year bonds. So often matching the duration of lending much more closely aligned to the duration of deposit. This kind of issue is very important when you start to dig below the surface of banks. Yeah, but and I just think maybe as a final thought here is, we've moved from incredibly lax monetary conditions in 2021, just kind of crazily, stupidly relaxed with all the quantitative easing that took place, to massive excess, and this was a major central bank error. And now conditions are really tightening up across the board, and you start to look at financial stress indices around the world, they're really rising quite rapidly. This will impact the portfolios more generally, and we have to really be scrutinizing how we invest, in the light of that. And I think so this is something that you and I and all of us here are pretty switched on to, and spending a lot of time analyzing.
Yes. Well, thanks very much. There is a Q&A button under your on the bottom of your screen, so feel free to click it if you have any questions. We've got a couple of minutes left. I mean, maybe just if I can follow up with that point that Paul, you made about how do you invest, how do you take calculated risks in an environment of tightening monetary conditions? What are the watchwords and the key criteria that you apply to growth stories that you invest in this environment? Yeah,
I mean I think keeping an eye on the broad money measures, it's going to give you a feel for how much the economy is going to grow. And in the US, those measures have gone negative. So we have to be pretty cautious about assumptions around economic growth in the coming year. Yeah, and just finally, I'll just see we've got one question coming in here. Mikhail, why don't I ask you this one? Should banks hold more capital? What about the AT1s?
Well, I think AT1s worked from what we've seen. The worry is, can bank raise AT1s? That's the concern at the moment. A lot of people lost a lot of money on AT1s, realize this yield pickup wasn't costly. So the question is, when they need to refinance their AT1 section of the balance sheet, how much investor appetite will be, and will be the cost of that. On the capital side, I'll just reiterate the assessment we've heard and agree with, that this was a liquidity issue more than the solvency issue, and capital is backstopping the solvency concerns. So I'm not a bank analyst, so can treat it with a pinch of salt, but I'd say the liquidity stress tests, and therefore a bank's ability to kind of pick up yield through duration mismatch would be hampered. But I don't think banks need more capital.
And very quickly, a couple of other questions, then we'll stop. One was, what's the price of this mass insurance for deposits going to be in the US? Obviously, we don't know this yet. I mean, what's interesting about banks is that you get these moments of illiquidity, and it looks like they're all bust, and then all they need really is time, and generally speaking, time allows them to settle all of their debt. So I wouldn't be surprised if the ultimate cost is pretty low, if not negligible. But it all depends on how long there is to sort out the problem. Generally, with these kind of liquidity issues, that obviously doesn't apply to CSFB. That's a different kind of case where you've got a solvency, a balance sheet, a loan book problem. And then finally, did we have any UK holdings banked with SVB? Yes, we did. I mentioned one that I asked why they did, and said what they said. And I think for a similar reason, many small businesses in the UK, certainly in the pharmaceutical and technology area, ended up banking with SVB UK because it was one of the few banks that would readily open a deposit account for them. Clearly those SVB UK incidentally has been having quite big inflows since it was saved. So there's absolutely no more issues in that respect. Great, thank you very much, and thanks, Mikhail, for hosting the session.
Pleasure as always, and just to remind you, if you have any subject that you think we should cover, then let your Amati contact know, and we'll endeavor to do it next time we talk, which will be in 2 weeks' time. Thank you all. Fantastic. Thanks very much.
Thank you.
Bye.